Hello and welcome to our fourth and final Peyton & Regal webcast for 2018. Before we begin, we'd like to extend our gratitude and thanks to each of you on the webcast. We've had a strong year of inflows within our Peyton mutual funds, and that has been driven by many of our partners on the line today. As always, we close out the year with our economic review and outlook. The goal of today's webcast is to look at the key themes that have unfolded in 2018, and then we'll take a look at what to expect in the year ahead. Presenting today, we have our always entertaining and insightful Peyton Economics team. Our economics team is comprised of Jeffrey Cleveland, Peter Beer, Sid Saravat. Jeffrey is a principal of the firm and our chief economist. He's a regular contributor on CNBC, Fox News, and various other media outlets. Peter and Sid are both integral parts of our economics team, and as a group, they are responsible for creating our Peyton Chart of the Week, quarterly point of view publication, and for the many timely pieces produced by our firm. There will be a question and answer session after their prepared remarks. We will compile those questions through the chat function on the webcast, which is located at the bottom right-hand side of your webcast browser. Please type in your questions at any point during the presentation, and we'll be sure to address them at the end. There will be a brief video during our presentation. If you're able, please unmute your computers at this time. With that, I'll turn it over to Jeffrey, Peter, and Sid.
Well, good morning, everyone, or good afternoon, wherever you are in the world. This is Jeffrey.
This is Peter. We're happy to have you.
Peter, it's good to see you again.
Yeah, it's been about 5 minutes, but we're back. We're back at it.
You stumbled back into my office, and we're here to talk about 2018 and 2019, so what to think about in the year ahead. But, you know, our philosophy is, and if you're not familiar with us, we're a bit unorthodox. I think our basic philosophy is we have to hold ourselves accountable to the predictions we made in 2018. So that's where we have to start first with what we like to call a post-mortem on the 2018 calls, and then we can look to the future. So, and the way we wanted to look at the future today, we kicked this around, Peter. What's a good analogy to use? And we stumbled on to remember the 90s.
Some of you may have wanted, I love the 90s. We advocated a little bit for that, but, you know, for those not familiar with the VH1 show, we just went ahead with remember the 90s.
So first and foremost, let's hold ourselves accountable. What were our predictions and what did we get wrong? Well, here you have it. This is the sheet that we presented in the forecast webcast at the beginning of the year.
Yeah, and I think if instead of going one by one, we'll give you kind of the general story we told going into this year. And I think the smiley and the sad faces kind of fall out of that. At the highest level, 2018, we didn't feel like we were going to head into recession. We thought the cycle would continue. And partly as a result of that, global growth, U.S. growth would continue to impress. The unemployment rate would continue to fall. Inflation would, as a result, rise slightly, and the Fed would kind of, in tandem with the labor market tightness and the inflation at target, hike 4 times, once a quarter. Going further out the yield curve, higher Fed funds rate, you have a little bit of pickup in inflation. We expected yields really to be higher across the curve, and with some steepening potential early in the year, even if, you know, as we close the year, the yield curve would be flatter, which ultimately I think is kind of where we ended up. Notably, we did see, as a result of our bullish econ fundamental view, some outperformance available for credit and equities. For those of you who are shaking your heads, rest assured we are too. But, you know, hopefully we'll do better next year on that front.
I think the other big area where we missed was just the global slowdown. So we had a much more significant slowdown in the euro area, for example, than we had anticipated. And we'll get more into the details of how we're thinking about global growth as we move through this webcast. But that's holding ourselves accountable in 2018, and we'll try to do better in 2019. That's the best we can say. So looking ahead, remember the 90s. I remember the 90s. Peter, do you remember the 90s?
Nothing says 1990s like a shirtless Mark Wahlberg. I can say that much.
Marky Mark taking a few swings there. The Big Lebowski.
Yep, we had, you know, presidents up for impeachment. Some of you may believe that should be the state of affairs today. Others may disagree.
We have members of Congress trotting out tech CEOs and interrogating them on Capitol Hill. Sound familiar?
It surely does. And Pets.com, well, we have Chewy.
Yeah, it's been reborn as Chewy. That's what's happened. Some ideas are just early, Peter.
We're not completely off base suggesting there are some similarities between today and the 1990s, but we'll use this as a broader framework for evaluating kind of where we are and where we think we're headed.
Yeah, history is not a perfect guide, but I think it's a relevant starting place would be our message. So on a more serious note, what are the broad similarities between the 1990s and today? Let's start with the first one.
Well, ladies and gentlemen, please mark 2019 as the year in which we exceed the record for the longest cycle in the U.S. history.
On record.
On record. Enver dated, which is the National Bureau of Economic Research, dating committee who decides what a recession is and isn't and how long the business cycle lasts. I think given where we are today and kind of the forward-looking indicators, we have every reason to believe that we will continue to expand into that record territory. And notably, even though if you look on the left chart, you'll see GDP growth hasn't been quite what it was in the 1990s. If you look on the right side, you'll see that payroll growth has been really consistently impressive. And where later in the 90s recession, we kind of saw that 6-month moving average of job growth really wane, we've continued to see strong performance in the labor market through 2018. If you look at the calendar year, we're probably going to average something like 200,000 jobs per month, net new jobs created per month, gets you up kind of in that 2 million range, so 2.5 million range. So that's an extraordinary mark for the labor market this late in the cycle, and those haven't been all bad jobs. We're seeing good job creation across sectors, high-paying and low-paying.
The other thing, it's very interesting, Peter, if you look to the left-hand chart again, this will be the longest cycle on record. So as you said, we're going to set a new record next year. However, the growth in the 1990s pretty significantly outpaced in terms of cumulative GDP growth what we've seen so far in this cycle. And from my perspective, I think you can take this two ways. You can say you can be a pessimist or you can be an optimist. The pessimist says, growth has been slower in this cycle. It's been lackluster relative to the 90s, so who cares about the length of the cycle? The other way to look at this, the optimist, is, well, we haven't really had the party. We haven't really had the booming growth to where we'll have an overheating environment and then a slowdown. So perhaps you could argue that this cycle has more room to run. So I think that's an important way to look at that left-hand chart. Now, why are we, Peter, so confident in our view that this cycle will go on and set the record?
The leading economic indicators, of course.
I think this is the picture to show to anyone, clients and otherwise, friends, families over the holidays who are questioning the durability of the U.S. economy right now. Our favorite index, a leading economic index. You can see here, typically, the leading economic index on a year-on-year basis is rolling over and dying. It's rolling over and dropping below zero well before the recession begins. So this has been a great leading indicator of economic activity. We did have something happen there, Peter, 2016.
Near miss, as we've highlighted, for those of you who recall the commodity price adjustment that really global commodity markets experienced, that fed through pretty strongly into the U.S. economic data. Industrial production went negative. We saw, obviously, a major downturn in kind of business fixed investment driven really by the heavier industries. But you may be wondering what actually goes into this index if it's just hocus pocus.
Wonder no more.
Wonder no more. We have on the next page kind of an attribution or a breakdown of the underlying components. And I know there's a lot of information on this page, so feel free to return to it at your leisure. What I want to highlight for you today, if you look at the 3-month change, you'll see a lot of red, meaning the index value today is lower than it was 3 months ago. But recognize that even though we've seen a little bit of slowing, that was off very high levels. And if you go to the far right column, which is the 12-month change in the index value, you'll see that we have a lot of green to kind of overwhelm that red. And that is really what gives us heart as we look forward 12 months and say we think the cycle can continue. However, there are, I think, particularly domestically, one main source of risk to our forecasts. The housing market in the U.S. has historically been an excellent predictor of broader business cycle dynamics, and you'll see that it is a pretty significant negative value. They use the Conference Board in their leading economic indicator index uses building permits, but we wanted to slice this for you a little differently. If you have a look at the following slide, what you will see, we've plotted for each state in the Great 50 the change in home sales, and this is new and existing home sales year to date. And I won't bore you with too much of the details. We did take some moving averages to try to smooth a little bit, but I think some really important stories emerge. Hawaii is obviously a notable outlier. There are a few things that could be at work there. First of all, it's a fairly small sample. We had some volcanic activity, which might have crimped some demand. And then finally, to the extent those are vacation home purchases, maybe we have seen some slowing there. But much more important would be kind of 2 through 5 or 6. And you'll see a lot of West Coast and Southwest kind of markets that have been really strong performers. That'd be Colorado, the Denver metro area, Washington, the Seattle metro area, Arizona and the Phoenix metro area, and obviously California have all seen pretty substantial declines in home sales year to date. On the flip side, if you look at some of the big gainers, obviously, I mean, who doesn't know about the hot Alaskan home sales market? I mean, it's just out of control. I'm sure a lot of you are following that carefully. For those who are not following Alaska, it's probably because you're so focused on what's going on in Wyoming and West Virginia, where we've also seen extremely impressive home sales. Again, those are smaller samples, but what I would highlight in terms of positive momentum, if you look kind of a little bit further up that list, you'll see a lot of states in the South: Alabama, Kentucky, Georgia, Florida, Vermont. Just kidding. Those states in the South are really kind of pushing higher, and so to the extent you're based on the West Coast and feeling a little bearish about the housing market, remember that there are other places in the country that are doing well, and if you're in the South, remember that there's some places in the country that are slowing a little bit.
So the bottom line, Peter, though, is housing is a risk to our view that the cycle continues. So it's a key risk. We're going to follow that closely. In particular, we're looking at home sales, but we're looking also at building permit activity. And if that continues to deteriorate, we would have a different tune, let's say, in 3 to 6 months' time. I think that's an important part of the way we do our outlook is to highlight where we could be wrong. And housing is a key area we're watching. But for now, we think we're fine. Second area that harkens back to the 1990s central bank policy, namely this chart, which I love to look at. It's the federal funds rate over the course of the 1990 cycle and the current cycle. And you can see some of the similarities and differences. One big similarity that I would highlight here is just you did have the initial hiking phase, the 1994, 1995 period, and then the Fed funds rate sort of hung out around 5% or so for a long stretch of time, where policymakers were arguing whether they were at neutral or whether they're at the preferred Fed funds rate. And these things can go on for some time. It doesn't have to be the case that you have a series of hikes and then a recession begins. So I think that's an important lesson for me, Peter, from the 1990s. You had to worry in the middle of the cycle. Then the economy picked up later in the cycle. So you had a mid-cycle slowdown and pick up, and then the Fed eventually started hiking again. This is an important lesson, I think, for investors to keep in mind when they're thinking about what could happen with the Fed, over the next 12 or even 24 months.
Critically, though, we like the 90s analogy. We recognize it's somewhat flawed and imperfect, particularly as it relates to kind of the Fed's framework. And this is half joke, half serious. Alan Greenspan was famously sort of mercurial and a wizard of monetary policy.
Obscure.
Very obscure. People wondering what was in the briefcase where he ate breakfast. Nobody knew the framework necessarily the Fed was using directly, whereas today we've sampled a quote from the vice chair of the Fed talking about how the Fed has moved towards transparency and how they're really focused on this kind of data dependence. So keep that in mind as we introduce to you our sort of rule of thumb and our forecast for rate hikes this year.
So what is the simple rule of thumb? Well, I think if we're right about the cycle, it extends. GDP growth continues next year, albeit a little slower than this year. 2.5% we think is a reasonable estimate for 2019. We think that's fast enough to push the unemployment rate down. The unemployment rate right now is 3.7, could very easily get to 3.4, maybe 3.3, depending on how you're looking at it. And that in that environment, our simple monetary policy rule that you see here is that if the unemployment rate continues to fall, the Fed is likely eventually going to be hiking again. We can argue about whether they pause, let's say in March, but this cycle, in our view, is not over. The unemployment rate has further to fall, and in that backdrop, the Fed is still going to be hiking. You see that, again, tie a lesson to the 1990s. If you look at this chart, there was some period there in the mid-90s where there was uncertainty about what was going on in the U.S. and globally. There were some rate cuts, you see, and then the unemployment rate kept falling, and the Fed said, oh, you know what? We got to get back in the tightening business, and interest rates eventually rose. So this will be the key. The second key thing we would say, where could we be wrong that we're following? If the unemployment rate doesn't continue to make new lows, then we would probably change our tune a little bit with regard to the Fed. And we show you that here on the following page.
But for now, ladies and gentlemen, introducing the Baton Economics rate hike forecast for 2019. We are sticking with 3 rate hikes.
Did we get a drum roll in there?
I think we should have a drum roll.
Who is running the sound effects on this podcast?
In any case, I think that 3 rate hikes is kind of more controversial today than certainly it was a few weeks ago. We've outlined some of the risks, the housing risk. You know, if the unemployment rate doesn't continue to fall, we, like the Fed, will be data dependent. But I think, you know, if you think the cycle continues, the Fed should keep hiking. And again, they may pause a little bit. It's worth keeping in mind that kind of we put their estimate for where they think that they want to get kind of in a neutral economy. That's currently the median of that orange range is 3. So once we hit 3% on the Fed funds rate, which if they hike next week and they hike 2 times, we're kind of there, or we're getting close to there. So they may pause after that. They may pause on the way to that. But I think 3 rate hikes in 2019 is kind of our call.
And Peter, what did you think of Jay Powell's analogy about the neutral rate? The fumbling around in the dark looking for the light switch.
I think he lifted it from you on a TV spot.
Okay.
Yeah, we put it out on the chart of the week a few weeks ago. There's no question that this is not a scientific process.
Right.
They are looking at the data just like we are, and just like I'm sure many of you are, as they decide how to kind of calibrate monetary policy.
And so if GDP growth continues, the unemployment rate falls, we're at 2% or a little bit higher on inflation, we do think they will be hiking. This is not priced in right now. That's that other curve that you see there, that strange-looking humpback whale type curve. That's the Fed funds futures curve, which has in mind maybe another hike and then a cut out in the further out the curve. And we strongly disagree with the market. We think the market is once again offsides on that.
Now, obviously, if we're talking about the Fed funds rate, that's going to have some serious implications for the yield curve. It is infamous, both in the mind of traders, in the mind of some of the FOMC members. There's been a lot of chit-chat about it, but we wanted to put some context around that for you, both what's going on and kind of why we care. So first of all, let's just establish what's going on before we talk about why we actually care. If you look, again, with the 90s referenced, today we're kind of flattening. You know, we've been sort of over the course of the recovery, we've been flattening generally, but we're still not inverted. And inversion is a key piece to highlight for a few reasons. But I think the key takeaway from this kind of historical trend is that even though we do kind of slowly tend that way, it's not necessarily linear. You can pause. If you look in the 90s, we've kind of got that orange bracket showing that the yield curve can remain flat for really a long time. And again, part of that reflects the fact that the Fed cut in 98, but nevertheless, it's not a one-way trade always and forever, but we just think there's a little bit of time before that inversion actually occurs.
We're also using this curve, the 3-month T-bill, the 10-year Treasury curve, to generate a probability of recession over the next 12 months. You see that on this page, sort of like akin to your probability of a forest fire type setting here. You know, do you have a high risk of a forest fire? Do you have a medium risk? Do you have a low risk? This forest fire being something we know, unfortunately, too well here in California. We still think it's a low risk of a recession over the next 12 months. It has ticked up a little bit. We recalibrated this week. It's now 15%. It was 14% last week.
And this is a critical detail for those who are skeptical of economists. Just focus on the yield curve. It is pretty much the best predictor we have. It's not perfect. Obviously, nothing in macro is. But other than one false positive in 1967, yield curve inversion critically, not just flattening, but inversion has signaled a recession with a 12 to, say, 24-month lead time in every instance in the post-war period. So when the 3-month bill yield is above the 10-year Treasury yield, you know, start to pay attention.
And those long and variable lags that you mentioned, Peter, the 6 months up to 18 months that we've seen in the post-war era, that really matters. So I think some investors have the misconception that, you invert, sort of like back to the light switch analogy, you switch the light off and the lights go out on the economy and the markets. No. Historically, there's ample time after inversion, but even before inversion, so when the curve is flat, we found that you still can have positive total returns in equities and in the investment-grade corporate side, and even in the high-yield part of the bond market. The credit part of the bond market can still eke out gains, even in a flat curve environment. I think that's a really important lesson for investors.
And this table hopefully gives you ammunition for clients that are worried about that inversion. You can show them over the last 3 cycles. Again, it's a small sample size. But nevertheless, we have seen, it's not necessarily or given that we see negative price performance in kind of risk assets after inversion.
If you don't want to use a table, by the way, one thing that I like to say is the yield curve inverted 3-month 10-year in February of 2006. And if you look at the S&P, it continued to rally into October of 2007. So you can use, I think, the yield curve as a good guide for business cycle and to gauge your risks, but I don't think it's a good asset allocation guide from that sense. All right, what else happened in the 1990s that is relevant for today? Well, a whole host of global issues, Peter. I mean, we could just pull many of these things. In fact, it's probably a good opportunity to introduce our colleague Sid, who has been here listening to our ranting and raving. And Sid, some of this strikes close to home for you, right?
Absolutely. In 97, I was a young kid in Bangkok, Thailand, dreaming about a day I would go to America. And what was happening? Asian financial crisis. See here, finance closed, business closed, Thailand closed. And I remember at the time, a lot of people were saying, hey, this might be the end of the cycle now. Or it was NAFTA, or LTCM. Similarly today, we've got another trade deal, got Brexit, got commentators going on talking about how the Fed's not doing its homework, might end the cycle. But you know what we say to that? We say the global economy is fine. Yes, it has slowed. But just like last year, people got really excited about geosynchronous growth. All economies were growing together. That didn't happen. Similarly, this year, on the other side, people are getting too pessimistic about global growth, that, okay, U.S. is okay, but the global economy is slowing. Yes, but one of our favorite indicators of the global economy, which is the Purchasing Managers Index, this survey is around 40,000 people, 18,000 purchasing managers in more than 40 countries. And we found that it's a pretty reliable gauge on what's going on globally, and does tend to correlate with global growth. And yes, it's slowed, but the key thing to remember is it's still above 50, which is the level that indicates expansion. In fact, in the latest report, Italy was the only country surveyed that showed contraction. So yes, the global economy is slowed, but we still think that it's expanding and should continue to expand next year.
Now, you mentioned Italy, Sid, and one of the common questions that I hear frequently is, okay, well, what about Italy? What's going on in Italy? How do you think about Brexit? And what about this global rise of populism? And we had to say, Charlie gave us a very fixed timeline on this podcast or this webcast, so we can't cover all of those topics in the detail that we would want to. However, we will say is some required reading.
Book recommendation, stocking stuffer alert.
Actually, this book might not fit. Depends on how big your stocking is, right? I mean, this is quite a hefty tome, but it's a juicy one, in my opinion. This book really is a great summary explanation of what we've seen in the last 10 years. And it's the rise of a public that's networked through the internet primarily and social media, and then the ramifications for that, which we've seen play out in Egypt, first and foremost. But I think this is a story of the rise of Trump, where he's able to rise to power without much of a political machine. Brexit, what we're seeing right now with the yellow vests in France, and what we're seeing with the two parties from sort of opposite ends of the political spectrum in Italy. So it really puts in perspective. So this is just a public service announcement to buy this book.
And critically, ladies and gentlemen, skeptics among you, I'm sure, deep state fans out there listening, Martin Gurry, the author of this book, actually first published it in 2014. No mention of Trump. It wasn't quite self-published, but it was pretty close. He was a former CIA analyst, kind of rolled out his own consulting business. And I highlight that because I know, at least personally, I'd roll my eyes if there was a book purporting to describe kind of the evolution and the rise of Trump after Trump. But this book actually locates itself and the causes well before Trump, and was written before Trump, before Brexit, before many of the things that today obviously people point to and say, well, populism's on the rise. I think he had his finger on the pulse very early, and for those interested, it is a terrific, terrific book. They just released the hardcover kind of edition, so this is the update. There are some comments specifically for those things, but read it.
And we don't get any money from this.
No money, no
ringing endorsement, okay? So we just want to be clear there. But this, I think, would help people understand what's going on and then be able to help explain things to client. I think the other thing to say, it is not, the story that it tells is not everything's falling apart. It's just recognizing the trends and the forces that are at play in the global geopolitical sphere. Okay, there is one striking difference, Peter, in my mind, between the 1990s and today. There's some good parallels, I think, but there's very big difference here that I think we should bring to the listeners' attention.
Absolutely and critically. You will see, ladies and gentlemen, a frying pan on your left. You may be wondering exactly what that is. We give to you now a little blast from the past.
Still isn't clear about what doing drugs does? Okay, last time. This is your brain. This is your brain on drugs. Any questions?
And we will leave it there. No, just kidding. I think the reason we bring this commercial to you, there were many worries, public service announcements in the 80s about your brain on drugs.
And 90s.
And 90s, and probably still to this day. Yeah. But we bring to you today, to investors around the world, a public service announcement that your brain may still be suffering from the effects of QE. We have over $20 trillion of assets on global central bank balance sheets, extended periods of low volatility in rates markets and equity markets. It is just critical to keep in mind that the regime we're in, and as we think about 2019 and the forecasts we make and the market moves we've seen in the last few months, it's not that bad, and we may be suffering from some lingering brain cell effects induced by or caused by quantitative easing around the world. We've moved a little bit away as the Fed has kind of initiated its balance sheet runoff. The ECB will probably announce this week the end of their asset purchases. The Bank of England has obviously been stable. The Bank of Japan has adjusted their yield target. So 2019 may see more of that, but we cannot stress enough when you see a 1% move on the S&P in a day. Today that seems weird, but if we were talking in the 90s, you might have been thankful it was so minimal.
So an important difference. All right, so how do we wrap this up and summarize the implications for the conclusions, market implications for 2019? No better way than, I think, return to the first page we showed you, the same page we showed you last week with at the beginning and last year, and with a few changes, of course. So U.S. and global growth. As Peter said, this will be the longest cycle on record, so we will eclipse the 1990s as of second quarter of 2019. The economy, the U.S. economy should grow around 2.5%. Yes, this is a little slower than 2018, which we think will have about 3.1% growth. But 2.5% is still above average of the last decade. It's above trend. This is more than enough to put downward pressure on the unemployment rate. The global growth story, as Sid mentioned, yes, we've seen slowing. We're seeing stabilization in the data, and we don't expect a more significant downturn a la 2015, 2016. Bond yields. We do still expect higher government bond yields across the curve. So two-year yields, yes, driven by the Fed, but also further out the curve, we think we can expect higher yields over the next 12 months. Importantly, this does probably mean that the yield curve could invert in the second half of the year, we think. But as Peter so eloquently described earlier, there are long and variable lags between inversion and the start of the recession, so don't get too fearful. Unemployment rate.
On the other macro indicators, the unemployment rate and inflation, we really see much of the same. The unemployment rate continuing to slowly grind lower, as it did this year, and inflation hanging out right around 2%. We got we got CPI data today. We're right just above 2%, 2.2%. We think that continues, and that feeds through naturally kind of into our central bank call. We already announced to you, confetti and drum roll to boot, the Fed hikes 3 times this year, but I would say for the more globally minded among you, look for the ECB to kind of maybe initiate or move off of their negative 40 basis point deposit rate target. Maybe not a full normalization, but just starting, even if only in conversation. Obviously, if we're this bullish or remaining anyway sanguine on the kind of outlook for the U.S. and global economy, we would be hard-pressed to pencil in negative returns for credit and equities. We did think about updating this. We're not just copying and pasting from last year. But the fact of the matter is we still see a positive outlook, both for risk assets and for the broader economy.
It's also possible here, Peter, that the U.S. dollar doesn't need to rip higher, I think, as some people worry about with our Fed view. The driver of the dollar in the last couple of years seems to be more the growth differential story, between the U.S. and Europe, for example, rather than the rate story. And if we're right about the global economy, then we could see the U.S. dollar top out here and stabilize or perhaps even weaken over the next 12 months. And I think that has important implications for global portfolios. So that's to round it out. Also, we do think the oil situation is primarily a supply story. That's what's driven prices down. So it's important to note it's not a demand-driven story. If it was more of a demand growth slowdown, we'd be a little bit more worried. So we expect a rebound in oil prices. All right, that is the summary of our key views, and we will hold ourselves accountable over the next 12 months. And the areas where we think we could be wrong, Peter, WCWDW, where could we be wrong? Is that's the acronym?
That's a clean acronym.
We're following the U.S. housing data, as Peter highlighted, in particular the permits data. If that starts to deteriorate further, we will raise red flags around this. The unemployment rate is going to be a key driver. If the unemployment rate continues to fall, I think that drives the Fed. And then, as Sid said, the global backdrop. We expect that to improve. If for some reason it continues to deteriorate, we change our tune. With that, I want to do one final sales pitch here. This is, in addition to generating views internally to help all the strategy teams, reporting to the Investment Policy Committee on a weekly basis, we do create a lot of publications. One in particular that we do each week, Chart of the Week. And you can sign up for any of these via the email there. We're happy to throw you on the list if you so desire, and we will not spam you, and it's free. So that's my sales pitch.
We really appreciate you tuning in and look forward to your questions.
Okay, thank you, Jeffrey, Peter, and Sid. I was remiss to introduce myself at the start of the webcast. This is Charlie Donovan, and I'm the relationship manager covering RIAs, family offices, and national accounts in the Midwest and Texas. And on the screen in front of you is the rest of our Payton & Regal Mutual Fund team. So we are now going to move on to the question and answer portion of the webcast. Again, to ask a question, please utilize the chat function, which is at the bottom right-hand side of your browser. And we did receive a few questions, Jeffrey, Peter, and Sid, during the webcast. And the first one comes from one of my clients out of the Midwest. His question is that we recently saw the 3s and 5s curve invert. If we shouldn't worry about the yield curve inverting just yet, what does it indicate?
3s, 5s curve, excellent question. One of my favorite questions in the last 7 days, really. We did our chart of the week on this last week, actually. And the title of the chart of the week is probably the best answer to your question. It was titled Worse Than Economists. And we were making a joke, Paul Samuelson, the famous economist, wrote the famous textbook, Principles Macro. He's quoted as saying that economists have predicted 9 out of the last 5 recessions. Just, making a joke that they often predicting bad things that don't happen. The 3s, 5s yield curve has predicted 172 of the last 7 recessions. So there's been 172 inversions between 3s and 5s. In using the daily data. If we use a monthly average, there's been about 15 inversions and only 7 recessions. So the short answer, Charlie, is it's just not a reliable indicator. We would much rather focus on our favorite indicator, the 3-month to 10-year Treasury curve.
Thank you for that. Another question we received. What in the world is going on with China, and what impact will that really have on the global supply chain?
So, by the way, the answer to that last question was another veiled sales pitch to sign up for the chart of the week. China it's tough. China, we're in the same boat as everyone else. We look at a lot of different data sources rather than just the standard government-issued data to try to gauge, to triage what's going on there. There's a couple of different indices that we follow. One that we would recommend is what Sid mentioned earlier, is just looking at the PMI data. China, you may be surprised to know, is the biggest survey respondent, let's say, to the global PMI. So there's 4,000 firms that are surveyed in the global PMI data for the Chinese Purchasing Managers Index. It does show that Chinese growth has slowed, but it's still on the plus side of the 50 scale. So it's not yet in contraction. So we think you have seen some slowing there, but we have not seen the rolling over into a recession that many commentators have repeatedly forecasted for, I don't know, Peter, years now.
Yeah, and directly to the supply chain question, I think there are 2 ways to answer that. One relates directly to supply chain, and the second relates to tariffs and the effects there. The first on the supply chain is that we live in a world now where global supply chains can be reconfigured and rejiggered, and a lot of that unfortunately stemmed out of the 2011 Fukushima disaster in Japan. That sent shockwaves through kind of global supply chains, and the ability to reorient and reorganize the kind of, let's say, chain of orders improved significantly through then. And if you're worried about tariffs and the slowdown on Chinese activity, one, if you look at some stock returns, clearly the Chinese economy has taken the tariff experience much harder than the U.S. economy. Not that we've significantly outperformed on an absolute basis, but relative to China, U.S. equities are doing much better. And secondarily, there are some reports that manufacturers, importers, and exporters are reclassifying some goods to avoid the tariffs coming out of China, which is obviously one of the major trading partners for the United States.
It's also worth noting, Peter, the manufacturing jobs data continues to look great, actually, even through November. We've added, off the top of my head, I think around 280,000 jobs in the manufacturing sector in the last year. And so we're not seeing a huge knock to that sector from, slowdown in China or the tariff concerns. It could show up. I mean, that was the prime area that I think the more bearish economic analysts and commentators were focusing on for the fallout. And we just haven't seen it. It could show up in the months ahead, but so far
And for those of you following very closely, if you remember that table with the leading economic indicator sub-indices, there was a new orders component from the U.S. ISM survey, which is, as you might expect, the index built around volume of new orders, and you do see that's down pretty significantly year on year. I think that is something that we might explain partially related to the tariffs. There may have been some front loading of orders in anticipation. So it's not that there are no effects. It's not that the Chinese slowdown or the tariffs don't mean anything. It's just at the macro level, when we do these kind of aggregate forecasts, it's hard to really handicap too much off of our base case based on something like that.
Okay, I think piggybacking on one of your last comments, the next question is, what effect has quantitative tightening had on the economy, and is it a risk moving forward?
Well, I mean, that was why we did that commercial there for the this is your brain on drugs, this is your brain on QE. So we do think there's some psychological effects that they're playing out. We do think, as Peter said, the volatility has been dampened across the board by the quantitative easing campaign. Keep in mind, central banks are not normal investors like everyone listening on this call. They're not buying and selling. They're not actively trading securities. What they have been doing, at least in the case of the Fed, for example, buying up treasuries and agencies and warehousing them, holding them, and just letting them roll off over time. And so we think that has a dampening effect on volatility.
Two other things to say. One, I think we owe attribution for the "This is your brain on QE" quote to a colleague of ours who was among the wisest and most grizzled of bond investors, who would, in a world kind of conditioned by the 1990s and even the 80s, looked at the situation today and just shook his head to say, "This is your brain on QE," looking at some of the market dynamics. The second thing to say, I think, as a risk we didn't highlight too much, because it's fairly kind of inside baseball for Fed watchers and money market participants, the Fed will face some interesting dynamics dealing with the balance sheet roll-off. Exactly like Jeffrey said, they've had a lot of inventory of safe liquid assets sitting on their balance sheet, and as they try to shrink the balance sheet, they may have some issues implementing their rate hikes. We've seen a little bit of that for those of you, again, who follow very closely, when you've seen the Fed shave 5 basis points off the top end of their range. That's part of the reason why. Please follow up if you have questions. I will spare the ears of the innocent who do not want to hear more about this, but it is definitely something interesting to watch, and keep your eyes peeled for headlines in 2019 about Fed implementation issues.
Peter, would a good summary of this be, I'm just thinking here, the balance sheet, everyone focuses on the balance sheet growing because of the assets they purchased. But what happened really was the Fed created a liability, one of their liabilities, which became a highly sought after, I would call it the safest safe asset, which was the reserves. And the reserves paid they do pay a nice interest rate right now, 2.20. And there's demand for that safe asset globally from all kinds of characters, banks, sovereign wealth funds, anyone who needs to say that. And as the balance sheet shrinks, so the quote-unquote quantitative tightening, the supply of that safe asset goes away. And investors have to find other places to park that liquidity. And so there you have, maybe T-bills, if the U.S. government needs to issue more T-bills, et cetera. So that's really, for me, the heart of quantitative tightening, that story. Do you think that's
Absolutely and completely, but broader market effects, I don't think, we're not of the opinion that, the Fed has taken away the punch bowl because they're letting the balance sheet roll off, and that's driving equities yeah. or spreads.
And that was a chart of the week as well a few weeks ago, so you can look that one up.
Okay, great. And with time here, I think we have time for one more question that I'll read to you, Jeffrey and Peter and Sid. And all other questions we will reply back through email after the call. So this question is a two-part question. How do you think about the impact of technology on both financial markets and the real economy? And then do you anticipate faster than usual shift in skills needed? And as such, will that cause more economic volatility?
Well, I mean, the short answer for me is this has really been the story of modern economies, advanced economies, for more than 200 years. So we're just continuing down that trend. If you look at the UK, the US, continental Europe over the last 200 years or so, it's a rise of automation, it's a rise of technology, of better ways of doing things with less human labor. And we've reaped the benefit of that in terms of a higher standard of living. So I think that the trend is continuing. Is it accelerating? We debate that all the time. I mean, in some ways, technology, some people will argue, well, the big advances in technology, Peter, are behind us. We had, the 747. When was that rolled out? And what real advance have we made from that? We're still traveling at 500 miles per hour on a plane. We haven't really changed that. Is the internet really ramping up our ability to produce things, or is it just distracting us? So I think you can have that debate around technology. But my bias is this is part of a great trend. We're figuring out more ways to do more, to create more output with less.
And in terms of labor demand and labor supply and kind of changing skills, I would say that actually the big story of the next 25 years, humble prediction here, if you think about the demographic evolution of the United States, I think what we may be up against more than anything is actually labor shortages as the baby boomers age out of the workforce. And the millennials are a bigger generation than the baby boomers, but critically what follows behind them, Gen Z or whatever the latest fashionable moniker for that group is not nearly as big as the millennial group. So there may be some serious labor shortages related particularly to some of the lower skilled jobs. So yes, it's true that at the high end, I think the demand for skill sets has changed and will continue to change and kind of refine itself to more, let's say, technologically inclined STEM for those who are thinking of sending their kids to certain schools or not. But nevertheless, there will be, it looks, at least from our vantage point, like a long runway for even the low-skilled laborers in the U.S. economy.
And then the final thing I think is that back to that book we were touting earlier, in terms of the immediate impacts of technological change, The Revolt of the Masses, or The Revolt of the Public. That book talks about the rise of the internet and the knock-on effects that we're seeing on the political process and ultimately on economic institutions as well. So I again, would double down on that book as a better, longer answer to that question.
Okay, perfect. Well, thank you, Jeffrey, Peter, and Sid. This is going to conclude our economic webcast. This has been part of our regular series of quarterly webcasts, so please keep an eye out for an invite to our next call at the end of the first quarter in 2019, as well as for a replay for this current webcast. From all of us here at Peyton Regal, we hope you and your loved ones have a wonderful holiday season and a Happy New Year.